Welcome to our discussion about mortgages, how much, how long, and analyzing trade-offs. My name is Krystian Cieplucha. I'm a financial consultant here at Alliant Retirement and Investment Services. Home ownership has always been an important part of the American dream, and the key to this dream for most folks is obtaining the right mortgage. The purpose of this presentation is to better prepare you for a home mortgage loan. Today, we hope to shed some light on the big questions that can impact your decision and experience. We'll try and help you answer 4 key common questions. Number 1, how do I qualify for a mortgage loan in today's changing environment? Number 2, how much house can I afford? Number 3, what kind of mortgages are available to me? And lastly, what changes might I need to make to my home loan over time? Before we get started, we'd just like to remind you about all the great resources available through our team here at Alliant Retirement and Investment Services. We offer weekly webinars, a podcast library, which I host, with new episodes posted monthly, our website, blog, and many other tools and resources. So before getting into specifics, let's understand what it takes to get a mortgage. A home loan can seem like a full-time job in itself, but really, once you have some basic information, the process will not seem so overwhelming. Knowing where the market has been in the last few years and where it may be going can be helpful in terms of understanding the big picture. According to the Federal Reserve, home mortgage rates are at multi-year highs, currently around 7.5% versus interest rates in the 3 to 4% area only a few years ago. When it comes to smart home ownership, you'll want to plan ahead, just like planning for college, your career, who you marry, and how many children you might have. Buying a home and obtaining the right mortgage are a big part of meeting all these personal financial goals for you and your family. The down payment will be the most significant expense of obtaining a home loan. Down payments can vary from 0 down to all down, but 20% of the purchase price is what you'll generally need to get the most favorable mortgage terms and avoid the purchase of PMI. PMI, or private mortgage insurance, is an insurance policy that protects your lender in case you default on the payments. As a borrower, you pay the premiums and the lender is the beneficiary. PMI fees vary from around 0.5% to 1% of the original loan amount per year. Paying down your current debt is also an important part of getting the best mortgage package. Reducing your total debt can help you better qualify, lower the interest rate on your loan, and free up more monthly cash flow to pay the new home loan payment you will eventually have. Mortgage loans can make home ownership a reality, but finding the right mortgage for the right home is a time-consuming balancing act. Doing your research, planning carefully, having all the information is important to make the right decision. The monthly mortgage payment is usually the single largest family budget item. Experts tell us that it should work out to around 25% of your gross pay, or 35% of your take-home pay. Statistics tell us the average length of time most people own a home is 9 years. If that's true, consider whether or not you should choose a 30-year loan. Also consider, should your highest financial planning goal be to pay off your mortgage or to invest for retirement, or maybe build an education fund for your children. Though finding the right mortgage can be tough, it's well worth the effort if it helps you achieve all the goals you've set for yourself and your family. In order to begin shopping for a home, most realtors will prefer that you be pre-qualified by your lender. While not a loan commitment, this does mean that you meet some basic requirements and stand a good chance of being approved for a mortgage loan. Real estate experts tell us that your purchase offer on a home has a better chance of being accepted if you're pre-qualified. There are 3 basic elements of pre-qualification: your credit score, your debt-to-income ratio, and the cash you have saved for a down payment. Credit score requirements have changed a lot over the last few years. Right now, you need a score of at least 680 to get a good loan rate, and an ideal score of over 720 to get the best loan rate. If your score isn't up there, take action now to improve it. Order your credit report and start handling any problems right away. Your proposed monthly mortgage payment, made up of your principal plus interest, will be divided by your gross monthly income. This figure should not go over about 28%. For example, let's say you earn $5,000 a month. You may be able to afford to spend 5,000 times 0.28, which equals $1,400 on your mortgage payment each month. Your total debt will be divided by your gross monthly income. This amount should not go over about 36%. So keeping with the previous example, if you earn $5,000 a month, you may spend 5,000 times 0.36, which equals $1,800 on your total debt obligations. So if you have a mortgage payment of $1,400, you can spend an additional $400 a month on credit card payments. Please note that this is just a hypothetical example. Your amounts may vary depending on your specific situation. You'll also need to have money down for a down payment and closing costs. There are government loans that allow you to put up little or no money down. Your seller might pick up some of the closing costs. However, if you get a conventional loan, you'll need money in the bank for these expenses. Lenders generally want to see a down payment of between 10 and 20% of the total purchase price. A home is more than just an assortment of bathrooms and bedrooms and countertop finishes. A home is where you will spend most of your free time, where you'll make family memories and entertain your friends. Making a good choice for your family is very important. Do your research online. Get to know the neighborhood. You can find out about home values, property tax rates, crime rates, other important information about the area that you're interested in. Research the school district associated with the area you're looking at. Call an insurance agent to get an estimate of the home insurance rates for your neighborhood. Should also consider things like your daily commute, local recreational and cultural activities, and the homes in proximity to the one you're interested in. All of this planning and research sounds like a lot of work, but consider the alternative. No one wants to buy a home they don't like in a neighborhood they're not unhappy with, and with a mortgage product that doesn't fit their needs. Let's consider Dan and Kate's story as a case study. Dan and Kate lived in a small apartment in a major metropolitan area with their 2-year-old son, Ryan. They were accustomed to walking or taking mass transit to and from work, eating at restaurants, and enjoying lots of different entertainment. They loved the culture and feel of the city, but found that growing their family in the city may not be what they wanted long term. Kate soon found that she was expecting their second child. Before they really had time to plan or think, they made an offer on a 3-bedroom, 2-bath home in a beautiful subdivision outside the city. They decided to take a no down payment loan with PMI because they had not saved enough for a down payment. Over time, however, Dan and Kate were unhappy with their nice new home because of the long drive to work and the burden for caring and paying for and repairing all that extra space. They never really sat down, thought about all the changes the new house would bring to their budget or to their lives. They eventually bought a second car for the 45-minute commute each day. Cost them more money, and they hadn't really considered it all. Dan and Kate did not take enough time to plan for smart home ownership. For many people, the increase over time on the real estate investment made in their primary home may prove to be their largest single asset. However, that home will potentially also be their largest monthly expense over the same time period. Choosing a home and the right mortgage are critical to a solid financial plan. How you choose to use each dollar of income will decide your financial health later. Major family financial goals include home ownership, education, retirement, and vacation savings. Each goal needs attention and thought, with careful planning for how each will be provided for in the overall picture. Smart home ownership is more than about getting the most house for your money. It's about meeting each of your personal and family financial goals. The general rule of thumb is that you could afford to buy a house that is equal to 3 times your annual household income. Using an online financial calculator, that can help you find out how much home you can afford. Remember that this is just a general rule. Try and avoid being house poor. House poor does not mean you could not afford to buy the house. It means that the cost of ownership keeps you from other things like vacations, saving for retirement, paying for education, and maybe even owning a reliable car. You want to consider your other financial goals. You want to save more for retirement. Are you just starting a family? Do you have children heading to college soon? Your life stage and goals should help you determine how much you want to spend on mortgage payments each month. Lenders have minimums and maximums, but don't push those limits just because you can. Please remember Dan and Kate, in the struggle to like the subdivision, they added an outdoor entertainment area for the kids, also a pool. All that meant they drove older cars and had higher maintenance costs, which cut into their vacation money and college savings. Fixed rate mortgages allow for repayment of debt and equal monthly mortgage payments over a specified period of time from 10 to 30 years. A 30-year mortgage is most common. Payments are credited first to interest, then to principal. If you can afford this loan and plan to live in your home for 10 years or more, this may be the best option for you. Unlike a fixed rate home loan, which holds the same interest rate over the life of the loan, the interest rate on an adjustable rate mortgage, or ARM, changes every year. ARMs come in many versions. For instance, a hybrid ARM features aspects of both adjustable and fixed rate mortgages. Hybrid mortgages are a type of ARM that offers a fixed rate for a predetermined period and then an adjustable rate for the rest of the loan term. If you're risk averse, tread lightly, as your interest rate and mortgage payments could be much higher in the years to come. For those buyers who need a rock bottom payment for several years, the interest-only mortgage product, as its name implies, allows them the option of paying only the interest for the first few years of the loan. You can pay principal if you wish. Interest only is an option. Interest-only loans are structured like an adjustable rate mortgage. An interest-only loan may be appropriate for home buyers who believe their income will increase in the coming years. For instance, young families or a professional just starting out. Remember, life changes and so do interest rates and home values. Sometimes it makes sense to refinance a mortgage, but do your homework to avoid confusion. If possible, work towards paying off your mortgage in full, but run several what-if scenarios to find your best option in terms of a possible refinancing. The questions of refinancing will come up, especially for those with adjustable rate mortgages and as interest rates begin to go up. When deciding whether or not to refinance your mortgage loan, some key pieces of information are necessary in order to make a good decision. The interest rate, loan balance, and remaining number of months on the current loan are important to compare to the interest rate, number of months, and fees on the new loan. Mortgage calculators can be found online to make you a more savvy shopper. Remember to compare the monthly mortgage payment and how long it will take to pay off the new loan before deciding to refinance your current mortgage. Think carefully before jumping into a new mortgage loan, and remember, if it sounds too good to be true, it usually is. So please keep in mind, homeownership is not a retirement plan. Your home may be your biggest asset, but housing prices tend to go up and down with the market. Retirement planning includes mortgage planning, and mortgage planning includes retirement planning. Before you make the home buying decision, getting a big picture view of your financial plan is important. The rule of thumb for annual earnings may be 25% for the home, 20% towards retirement, 10% for savings, and 10% for education. These are only standard guidelines. You'll have to make your own adjustments. Whether you work with a financial professional or do your own planning, you may be more successful with a financial plan in place. At times, it all may seem a bit daunting, but it's more about making one good decision at a time. Our goal today was to give you guidelines, tips, and tools to help you make great decisions. We wish you the best of luck on your journey to home ownership. Thank you for your attention and participation. We hope you'll take advantage of the information and resources we've provided. My direct line is 213-320-8060 if you'd like to reach me with any questions about financial planning, mortgage, or investment planning. I'll now be happy to answer your questions.